Credit Suisse could collapse. Let's have a look. Hello everyone, Florian here, and welcome to another episode of HeiseSays. Grab your stein of coffee because I want to have a look at this article written by Frank Chung, news.com.au. Fears Credit Suisse is on the brink of collapse. One of the world's biggest banks insists it is in a strong financial position amid fears of a looming Lehman Brothers moment that could spark a major crisis. Now, if we jump over to the other screen, we can see their share price has steadily been going down, closing at 361, much lower than where it was just before the GFC. And if we have a look here at Google Trends, we can see we've had a little spike in searches for their name. It spiked up, a couple of months ago, and in 2021, if we go all the way back to 2008, you can see it peaked a few times here. And, well, you can see number one is Switzerland, not surprising. Number two is St. Helena. Okay, maybe someone can enlighten me as to why that would be. So let's have a look at this to see if it's something we should be concerned about. Credit Suisse is scrambling to reassure investors and clients about its liquidity and capital position as rumors swirl that the major global investment bank is on the verge of collapse. The troubled Swiss lender, which has seen its share price plunge by 60% over the year to a near record low following a string of scandals and losses, saw a sharp rise in the spreads on its credit default swaps on Friday, sparking fevered online speculation. This is the risk with the rumor mill, but you never know. Credit default swaps offer protection against a company defaulting on its bonds. The rapid rise last week of around 15% to levels not seen, or not last seen, to levels last seen, in 2009 during the financial crisis, suggested investors were worried about Credit Suisse's financial health. The Financial Times reports senior Credit Suisse executives spent the weekend hitting the phones trying to calm nerves. The teams are actively engaging with our top clients and counterparties this weekend, an executive told the newspaper. We are also getting incoming calls from our top investors with messages of support. That came after the group's chief executive, Ulrich Coroner, issued a memo to staff on Friday saying the bank was at a critical moment as it prepares for its latest overhaul. The details of the major restructuring, which is expected to include up to 5,000 job cuts and asset sales, are set to be revealed in a strategic review on October 27th. This doesn't sound very good at all for them, does it? 5,000 jobs cut. Let's look at how many staff they have. Let's jump over here. Okay, so a 10% workforce cut. They've got 51,000 employees. That's still a significant number. In the memo, Mr. Kroner stressed the bank's strength, telling employees not to confuse the day-to-day share price performance with its strong capital base and liquidity position. No doubt there will be more noise in the markets and the press between now and the end of October, he wrote. All I can tell you is to remain disciplined and stay as close as ever to your clients and colleagues. I know it's not easy to remain focused amid the stories you read in the media, in particular given the many factually inaccurate statements being made. That said, I trust that you are not confusing our day-to-day stock price performance with the strong capital base and liquidity position of the bank. But if you were working for this bank, would you be looking for another job now, to be honest? Depending on your position. I mean, if you're close enough to retirement, you may just go, screw it, I'll just ride the ship down, ride it out, get everything I can. Or if you're young, it may be time to start shopping around, get the CV going, jump on LinkedIn, talk to some people. Speaking to the Financial Times, a Credit Suisse executive also denied recent reports that the bank had approached investors about raising more capital. The executive insisted that the bank was trying to avoid such a move, with its share price near record lows and higher borrowing costs due to ratings downgrades. As Bloomberg noted last week, the market capitalization of Switzerland's second largest bank has dropped to around 10 billion Swiss francs, 15.8 billion USD, down from more than 30 billion, 47.5 billion USD, as recently as March 2021, meaning any share sales would be highly dilutive to long-term investors. Oh, are they? I mean, do they pay a dividend? I'm having a look here. Yes, okay, well, they've got a dividend yield of 2.78%, guys. What do you reckon? Contrarian investor investing against the news when others are fearful? You tell me in the comments, guys. Would you chuck a little bit of money at it? Credit Suisse executives have previously noted that the bank's CET1 capital ratio, a measure of financial strength, which compares a bank's capital against its assets, was 13.5% as of June 30, well above the 10% required by Swiss authorities and the international regulatory minimum of 8%. A point of concern for many stakeholders, including speculation by the media, continues to be our capitalization and financial strength, staff were told in another internal note on Sunday. Our position in this respect is clear. Credit Suisse has a strong capital and liquidity position and balance sheet. Share price developments do not change this fact. Online commenters remain unconvinced, with Twitter users mockingly referring to the bank as Debit Suisse. Meanwhile, Deutsche Bank, which has seen its share price plunge 40% over the past year, is also rumored to be in trouble, with its credit default swaps also rising in recent days, as analysts raise similar questions about the German lender's financial health. Both Credit Suisse and Deutsche Bank are deemed globally strategically important banks, or too big to fail, meaning both would likely be subject to government bailouts. Together they manage around 8.2 trillion in assets. Okay, so let's have a talk about this. Here's the thing, when you're talking even Deutsche Bank, Credit Suisse, these big banks and concerns about them failing, or the rumor mill about them failing or being in trouble. We've talked about this all many times before, even on this channel, particularly Deutsche Bank. Just the rumor mill loves to spread concern about them. And I mean, honestly, I think it'd be similar to here in Australia. The government would happily sacrifice future and opportunities of the younger generation to ensure the continuation of these organizations. I mean, can you see any one of the big four banks falling over here in Australia and the government not intervening? I mean, what was it? Pyramid down in Victoria, they went over. They just put a tax on every citizen and everyone got their money back eventually. So, I mean, there you go, guys. Is this something we should fear about? We have the sirens blaring and everyone being crazy, and I don't know. We'll hear it too many times. I'm getting numb to all the constant economic fear and crises. We'll have to see, but that doesn't mean maybe I've just been reading too much. Maybe it's about to topple over. But I mean, they're firing 10% of their workforce, guys. So it isn't good times for them. We'll have to see. Let me know your thoughts in the comments below. Or would you invest in them? As always, check out my other channels, HeiseBim and HeiseSays International, for other content I create. And if you want to support us, there are a few ways you can: financially on YouTube or Patreon, using our referral links, buying our pocket squares, or calling us if you need an architect. Take care, everyone. Have a great day, and I'll see you in the next episode of HeiseSays.